Fund Supermart, your online gateway to unit trusts.
Yes. Hi. So my name is Keen. I'm going to be moderating this session, this panel. So how it works is that I will ask questions addressed to the speakers, and then it will be individually, and then later there will be some questions as well to the panel as a whole. And then perhaps halfway through the session, we'll open it to the floor. So there are actually two mics that are placed in the middle alley. So for those of you who have a question in mind, later when I open up the panel to the floor, you can go up to the mic and ask a question there. If you are not comfortable about asking a question from the mic, if I'm not wrong and I'm not mistaken, there are also forms of paper inside the bags, your goodie bags as well. So you can write your desired question you want to ask and address the panel on a piece of paper, and you can pass it to the runners on the side, okay? And those questions will filter up to the stage. Okay, so let's start. I will ask a question for each speaker, and I'll ask my IFAS bosses and colleagues first. Okay, so, Mr. Song Hui, we enjoyed your presentation on your outlook for the year. So the talk currently now in the markets is China. So what is your take on the Chinese equity markets at this point of time? Should we invest in Chinese equity funds?
Okay, I think I'll first start off by addressing the question on Chinese equity markets and the underlying economy. So I think the underlying economy has been, as everybody knows, rebalancing, restructuring for the past 2 to 3 years. Okay, but there's been quite a fair bit of worries recently, especially with, I think, the first data point coming out in 2016, whereby I think manufacturing actually missed estimates. Okay, but to be honest with you all, we don't think it's that serious of an issue, given that the Chinese government has consistently said that they are rebalancing and restructuring their economy from being more manufacturing and export-oriented to one more service and tertiary industry-oriented for domestic consumption. Okay, PMIs, or Purchasing Manager Indices, readings for business activity in China, they've been negative for the past 2 to 3 years for the manufacturing side. Okay, so weakness there has been ongoing. Nothing much has changed. It's still restructuring, reorganizing, and certain SOE reforms are being implemented. Okay, but if you take a look at the services PMI, which the government is focusing on to drive the economy, I think you would be pleasantly surprised to note that they've actually been positive over the past 2 years since they started tracking services there. Okay, we have yet to see a decline in business activity, okay, although a bit of deceleration might have been seen. But by and large, we actually see the services economy in China picking up. So for the case of the Chinese equity market, I think it's more of sentiment leading the market down rather than economics and business activity actually decelerating significantly, especially in the services industry.
Okay. Thank you for that. You also mentioned in your presentation about adopting certain defensive strategies earlier. What are some of these measures that retail investors like ourselves can adopt?
Okay, for defensive strategies for the once previously richly valued markets like US and Europe, okay, they've come down quite a fair bit, I think almost 10% on a year-to-date basis. Okay, but defensive strategies for these two markets, I think you'll be looking at some of the long-short strategies we have on board the platform. I think one of them comes from Neuberger Berman, the US long-short equity fund, which we actually talked quite extensively about it last year in June, July, before the current carnage and mayhem. Okay, so a long-short strategy fund is actually, I think Benny explained a bit of it just now. It's not to make that much money on the short side, whilst your relatives and all are suffering on the long side, but rather is to protect yourself and reduce your market exposure. So instead of being fully exposed to the market, you let the fund manager short stocks he believes are unattractive to help counter some of the long side positions he has in his portfolio. Okay, long-short strategies have tended to show that they have lower drawdowns and lower volatility numbers as compared to long-only equity funds. Of course, on the upside, they might not perform as well, during a raging bull market like we had for the past 2 to 3 years. But by and large, long-short equity funds tend to be quite a good avenue for investors who want to be more defensively oriented.
Okay, you heard it, folks. So check out long-short funds for defensive measures that you can take. Okay, so I'll move on to Terence. Okay, you look very closely into bond market segments, and I think I do believe that there's a bond market segment that performed quite decently last year, and it's actually Asian credit, Asian bonds in general. So should investors continue to stay invested in that segment? And what is your take on the Asian high yield segment as well for this year?
Okay, so we actually have liked the Asian credit space for quite some time. Just now that chart I pointed out, when we didn't like US high yield, we actually pointed investors towards Asia, Asian credit, Asian high yield, and I think that segment has outperformed quite considerably. Last year was a bit of a complicated year for Asian credit because we had, I think, the first offshore Chinese developer default in Kaisa Holdings, Kaisa Group, which sent Asian credit down quite a bit at the start of the year. And then after that, the market normalized, and Asian high-yield bonds actually delivered quite a decent return, I think in excess of 4+% by the end of 2015. Okay, so this year, given the carnage we have seen in Asian equities, I think Asian bonds still can provide a bit of that buffer you need if you still want exposure to Asian growth. I think the Asian growth story is still very strong, primarily dictated by what's going on in China. I think Asian high-yield bonds this year are just off by barely 1%, in contrast to what's going on with that 9-10% drawdown in Asian equities. So long story short, we actually quite like Asian fixed income, Asian credit, which on the whole gives you about 4 to 5% yield. Asian high yield, 7 to 8%. We quite like the Chinese property developer space, where we think the sector continues to be a beneficiary of Chinese monetary policy as well as housing policy easing. Okay, so I hope that answers your question.
Okay, thank you, Terence. Okay, we'll move on to Ben. For your presentation, I think it's quite interesting. We are curious as to what are some of these possible risks that you see that could affect the performance of Asian small caps this year, and how are you going about to possibly mitigate any of these risks, if there are any?
I think the key risk, which has been mentioned a lot today, is potential for a hard landing in China. HSBC Global Asset Management apportions a very low risk of this event. We actually think China will have more moderate to low growth. So we're not too concerned about that risk. Another key risk is around currency movements, and I'll focus on a couple of areas. The weakening of the renminbi has really played on markets, and interestingly, China's actually had a tough time explaining itself. Normally when countries go through a currency weakening event, it's often a catalyst for the share market, but in the case of China, there happens to be an exception to this rule. Currency weakening has been viewed as a sign of economic weakness, and that's possibly slightly unfair. On the other hand, in terms of how we're playing currency otherwise in the Asian small cap portfolio, we effectively have a long US dollar position. And when I say long US dollar position, I'm not referring to a currency hedge, but rather we have a bias to companies that have US dollar revenues. And that's actually been a positive thing in terms of our performance through the last 12 months. And we continue to have that positioning into 2016. So that's part of our defensive strategy. Final area of risk is the potential for policy reform to stall. So one key area for one key catalyst in terms of Asia's prospects, in terms of equities more broadly in its economic profile, is that policy reform continues to push forward, whether it be reform of state-owned enterprises in China and taking out excess capacity out of the economy, or GST or tax reform in India. There's various examples of reform throughout Asia, and it's very important that the reform agenda continues to unlock value and potential within the Asian markets.
Thanks, Ben. Based on the fund's geographic breakdown, we noticed that there is some exposure to South Korean companies. What is your outlook on the South Korean economy at this current juncture?
Korea does face some uncertainties. As you're probably aware, it's a big exporting economy. It's a big manufacturer and a big exporter, and it faces, I guess, some uncertainties in terms of its position in global trade. I think also there's perhaps a bit of a headwind in terms of its products that it exports, in terms of the tech sector and hardware, which is going through a little bit of a hard time at the moment. More broadly, though, we see good potential in Korea in terms of its re-rating potential, and re-rating potential will likely come from a corporate governance reform. Now, the key triggers for reform in Korea that we're observing is government taxation, which is encouraging Korean corporates to pay out higher dividends, pay out higher wages, and invest more. Part of the reason Korea trades at a big discount, particularly in the large cap space, is that it has poor relations with its shareholders, and any improvement in this and its treatment of shareholders would be a positive catalyst. Another driver, aside simply from policy, government policy in terms of chaebol reform, is actually agitation from key shareholders in Korea. And one interesting example is the National Pension Scheme, which has about 7% of the Korean equity market, which makes it a massive marginal buyer of equities and an agent of change, and has tremendous clout. So what we've noticed in the last 12 to 18 months is, from a pretty low base, some very positive trend improvement in the payout ratios in terms of profits being returned to shareholders through dividend. And if we see this trend continue, which we're optimistic that it will happen, that re-rating of Korean equities will perhaps occur. I have to point out, though, that Korea is really a tale of two markets. We have a very cheap large cap sector, but a very, very expensive small cap sector. And that's really been a result of domestic investor participation and rally in tech, consumers, and healthcare stocks. So in our small cap strategy, we're actually underweight Korea, but in our larger cap strategies, we're more constructive and overweight on Korea.
Thank you, Ben. Okay, we'll move to Neuberger, Adam. Okay, I think there's the bond market segment that caught a lot of tension among both institutional and retail investors, especially the US high yield bond market. So I believe that almost every speaker here talked about it today. Is there value and opportunities now, given the overall rise in yields in recent times? And if there are, how are you or your team going about navigating the high yield space at this point of time?
Certainly, I think the short answer is yes. We do see opportunity in U.S. high yield, but I would have to caveat that. There's certain segments of that market that are going through real stress, and prices, because of that stress, are justified. So, what I would not advise is buying a ETF of high yield, because you're going to take on everything in that market. I guess the analogy would be the baby being thrown out with the bathwater. I think the market right now is trying to find kind of a floor to pricing overall in high yield. The areas that we're avoiding are very much the commodity segments of the market. U.S. shale producers have been pretty significant in financing themselves in the U.S. high yield market, and with energy, or more importantly, oil prices down at 30, I think yesterday touching on $29 a barrel. That's not an economically viable proposition for many of those E&P companies. That said, the rest of the universe looks in reasonable shape, and the important consideration that's supporting that is the overall growth environment for the U.S. So outside of the commodity space, metals and mining, oil and gas, we are seeing opportunities, and that comprises about 80 to 85% of the high yield market, non-commodity specific segments. So we're taking a very bottom-up, bond-specific approach, company-specific approach, and in particular, avoiding the commodity space. The other thing to consider is the yield you're getting paid, which today on the index is around 9%, 9.5%. Relative to the potential for default, and are you being overcompensated for that default risk in that segment? Last year, the default rate in the high yield market was about 1.8%. The long-term average is about 3.84%. Assuming that we do have significant stress in energy, our expectations are we will see stress in energy this year. Our expectation for defaults in high yield has gone from last year 1.82% up to 3%. If we see oil in the 20s, maybe it goes from 3 to 3.5, potentially 4. But it's still in line with the long-term average for the asset class. And the reality is today spreads and yields are higher than the long-term average, particularly spreads. And we do think that you're being compensated, provided you're avoiding some of those very stressed segments of the market that do have higher than average potential for default.
So I guess you have to be more active and selective in that segment. So you can't buy an ETF for it because you're not getting that benefit of that. So you can talk to Adam later if you're interested. Okay. The second question that we have for you is, given that you have greater flexibility in your bond fund as compared to traditional bond mandates, can you please describe your top conviction ideas that is unique to your fund?
Sure, and I think that's an important consideration given all that's playing out in broader capital markets today, and I think that's been referenced here across the presenters is flexibility. Having the ability to not own or potentially short what you think is bad, and be long and diversified across various investment ideas that we think are promising and good looking forward. So the highest level thesis of where we're finding conviction in our investment ideas would be selective opportunities in the corporate bond markets, high yield being one of our favorite spaces, also some of the mortgage-backed space in the U.S., given the ongoing resilience and strength of the U.S. consumer. We think those are promising from a credit fundamental perspective, that there's not going to be default risk there where we're buying those names. And two, that they mesh well with our overall view of the U.S. economy, that we're not going into recession in the U.S. The U.S. is showing reasonable signs of growth and stability. You know, we're not talking about 8% growth in the U.S., but a 2% growth handle with benign inflation is very much supportive of these corporations, and as a bondholder in those corporations, getting paid on that principal and not having it overly eroded by inflation and a very aggressive Fed. So very much a credit bias in our portfolio, but diversified across the credit segments that we like: corporate bonds, residential mortgages, floating rate bank loans, and generally avoiding many of the traditional government bond markets where we just feel yields are way too low relative to a potential very pessimistic world. We view a more glass half full type of approach. We think growth should be reasonable versus the market today, I think, doubting that to a degree. And bond yields that are too low and have the potential to rise are not attractive in our minds. So we're avoiding and actually shorting the U.S. Treasury market, as I mentioned in my presentation, avoiding and shorting the German bond market, given that those bond yields are not attractive at all in our minds relative to growth and inflation potential, and likewise for Japan. So building a diversified portfolio is important, but those are certainly some of our top conviction ideas.
Thank you, Adam. Okay, we'll move on to Benny. Okay, I think I and a lot of people enjoy your presentation quite a bit. Your volatility and risk has actually been a key concern, I understand, personally for myself as well, for investors last year and probably soon, this starting of the year. Okay, what can investors do now to better manage some of these market conditions?
Well, I guess risk is a really big discussion in the markets right now, and how we can manage that will probably be key to how much we are going to do this year. In our multi-asset portfolio, we manage risk above everything else. We keep it within a 5 to 8% percentage in terms of the standard deviation, and that's how we believe that your returns can come naturally. I mentioned earlier that it doesn't really matter what the markets are doing or how your manager is managing the fund when the markets are up. Most people will make their money. But it is when the markets are down, how well you hold your value, how quickly you're able to move your portfolio around to negotiate the risk in the market. I think that's what's very, very key. I think these days, we need to be a little bit more innovative in the instruments we use. I'll give you an example. Fourth quarter last year, my portfolio management team didn't think that the US equity markets were going to have too good of an earnings season. At that time, we were holding on to maybe about 25% of US stocks within our portfolio. What was our decision then? Number one, it would be very costly if we were to reduce the entire allocation from our US stock holdings, because that's 25% of 4 billion. Also, at the same time, it would cost us a bomb in terms of transaction costs to take away that 25% allocation. What we did instead was to use derivatives. We hedged out a position, our US equity position, very, very immediately at a very low cost, without being forced to unwind the US position at prices which were not exactly favorable for us. So using derivatives, right? I mean, most of you, when I say derivatives, you probably think I'm using a bad word since 2008. Derivatives can be used in many ways. My fund uses derivatives not to increase your exposure, but to reduce exposure when we think it's needed. So risk management is going to be the key topic for 2016. And the volatility is going to be triggered by all sorts of market events or geopolitics, and of course, the terrorist actions that we've been seeing of late. So anything can trigger. How do we ensure that we are well protected? And also how we can possibly participate when the market does turn for the better. I think that would be the key.
Okay, I got a second question for you. I think last year, at this point of time last year, I asked you about your thoughts on the Eurozone economy and whether it's a buy. So I think for people with currency hedged in place, I think European funds last year did have a decent return. So for this year, what's your thoughts on the Eurozone economy and what kind of opportunities can investors look forward to in Europe?
Thanks for bringing that up. By the way, my German equities fund is up close to 30% after last year. But with that being said, we always like Europe. Not because I come from a German bank. Europe is at a different time zone to the US, both in real time and as well as monetary policy. They are now still in the midst of loosening. They're trying to pump liquidity into the economies. They're trying to give money is very, very cheap, which allows companies to invest in their businesses and reward their investors. How is a cheaper Europe going to benefit how is a cheaper euro currency going to benefit European companies? A lot of these major global brand names, consumer brand names, they have a big export business. And with a cheaper euro, it is actually better for them because it's cheaper to sell their goods. Also, at the same time, with the lower commodity prices, that's going to really benefit the consumer markets. It is estimated that a 10% drop in oil prices actually contributes to about 0.13 to 0.15% of GDP in Europe. So we think that Europe will continue to do well in terms of equities, but do be cognizant of this. When we talk about a good European market with quantitative easing and a loose monetary policy, we're really talking about Eurozone countries. Countries like the UK and Switzerland, not really part of the Eurozone, those a little overvalued. So we like Europe, and we think that there's strong tailwind that's going to push the consumer markets over in Europe, and therefore we think that it's still a good area to look at.
Okay, so have Europe in our portfolio. Okay, so now we'll open the panel to the floor.